Hi, welcome to today's Technically Speaking update here at realinvestmentadvice.com. Of course, the Lance Roberts Show as well. That's where we talk about the markets in particular, as we've been discussing here over the last couple of weeks. You know, we're moving into the end of the year, and of course, the big hope is whether or not Santa Claus will come and visit Broad and Wall. That's right, the annual Santa Claus rally. Everybody's hoping to plug one into their stocking at least as we head into the end of the year. Let's talk about a few things that are going on right now. We'll talk about the odds of a Santa rally and what we're particularly doing right now. First of all, yesterday we broke this very important neckline of the market yesterday, tested the lows that go all the way back to January of this year, but we're able to manage a recovery back above this neckline. This keeps the market confined within this very consolidated pattern that we have going on right now. This is not overall a bullish indication of a market. It's just simply a market that continues to consolidate here to the end of the year. We do have upside in this range to about 27.55 to 27.60 most likely, and that's the numbers that we're looking at here for potentially, if we are going to get a Santa rally, we'll get it from there. Now, taking a look at some of the internals, though, it certainly doesn't stack up to this idea that we're going to have an exceptionally strong end of the year rally. Markets are not egregiously oversold. Back in late October, early November, markets had gotten very oversold. This recent sell-off, which tested the lows going all the way back to February, did not even get us back to those recent oversold conditions. So again, the catalyst or the fuel for a bigger rally going into the year simply not present right now. And also taking a look at the markets from kind of a bullish attitude. You know, one of the things is when we talk about bullish experiences, etc., those are contrarian in nature. So when a lot of people are very bullish on the market, that typically indicates a contrarian nature. In other words, that's the time to be taking money out of the market. When people are exceptionally bearish about the market, that tends to set the markets up for a rally. But as you'll notice, really, even despite the fact markets are testing the lows back from earlier this year, we did not get to exceptionally negative territory in terms of bullish or bearish attitudes. And that even goes to our chart of this 4-week moving average of investor positioning. Now, this is a combination of multiple types of measures of investor positioning, both individual as professional as well, pension funds, hedge funds, mutual funds, etc. And while we have come off this extreme greed level, we are certainly not back at levels that have historically denoted major bottoms like we saw in 2015, 2016, or 2008, 2009, or even 2011. We have certainly come down here, but again, not to the levels of extreme fear that would be needed for an exceptionally strong return to a bull market. So likely what we're seeing here is potentially an opportunity for a trade, but probably maybe not much more than that. This also kind of goes with the same idea when we take a look at high-low percentages. We are getting oversold here on a short-term basis, enough for a rally, but not to the real depths of the magnitude of oversold conditions that you would expect for a major bull market rally. The same thing here when we take a look at on-balance volume and what's happening with the markets. We're seeing momentum turn lower, advanced decline percentages turning lower, volume turning lower as well. So again, all of these conditions are precedent to a market that's still within a correctional type phase right now, and certainly doesn't warrant taking on an exceptional amount of risk. Now, having said this though, here's the important thing. The markets right now have made a major change that is certainly important to look at. Earlier this year, when we went through this correction process back in February, March, and April of this year, the markets always traded above basically their long-term moving averages. Now, all major markets, the S&P 500, the NASDAQ, as well as the Russell 2000, all trading well below their long-term moving averages. That's typically more bearish in nature. And again, this suggests that the downward pressure on prices still remains currently at this time. So again, taking on an exceptional amount of equity risk at this point certainly doesn't make a whole lot of sense. But taking a look at historically how the month of December racks up, we're actually seeing a lot of similarities to what we normally see setting up for an end of the year rally. And what this chart shows by Michael Leibowitz, of course, here at realinvestmentadvice.com, is that the bulk of the trading days that turn out to be positive for the markets are coming up. In the first couple of weeks of December, mutual funds, pension funds, hedge funds, etc., do a lot of their distributions for the year, tax purposes, etc. They get underweight equities and they need to add positions back to their portfolio. This is what's called seasonal window dressing. It happens at the end of every quarter. Mutual funds in particular want to show they have the top stocks in their portfolios, and if they've liquidated those, they are going to buy those back. And more importantly, a lot of mutual funds have specific requirements for the amount of equity allocations they must maintain at all times. So they've got to get their books back in shape by the end of the year. And so typically we see some buying going into the end of the year as this window dressing occurs. The question is looking at the seasonal run of returns, it's about a 1.5% increase on average. The Santa rally adds about 1.5% to the markets and occurs between really about the 14th through the 26th of the month. So we're coming up on that next week, and of course, as we get into the 18th and 19th this month, we'll be hearing from Jerome Powell. Of course, any comments coming out of Washington about improvement in trade issues, etc., could certainly give a lift to the markets in the short term. But there's some basic rules now that we need to follow for this type of rally. And we're looking at adding a trading position to portfolios here just for the market rally here into the end of the year. Again, we're not expecting a whole lot, maybe a rally to 2750. But the rules are pretty simple, which is, make sure and tighten up your stop losses for all your positions. We're currently going to be running a stop loss in our trading position at 2633, which is the bottom of that neckline that we just saw at the beginning of this presentation. That's also the important support point for the markets at this point as well. Also, hedge your portfolios against major declines. Again, we've been holding a lot of extra cash. We're continuing to do that. Cash is a great hedge for a portfolio when you're not sure what direction the market's going to take. There'll eventually be an opportunity to short the markets, but you don't short the market until you get to a real defined downtrend in the markets. We're not in that yet. We're still in a major consolidation pattern this entire year going back to February of this year. So not time to short yet, but certainly hedge your portfolios. Extra cash, fixed income have been great hedges this year for volatility in portfolios. Take profits and positions you have big gains in, of course, and most importantly, sell your laggards and losers, because again, if they didn't participate on the way back up and they don't participate in a rally, they're going to really get hurt much worse in a bigger decline, which is likely to come next year. Of course, raise cash, rebalance portfolio risk accordingly. If this market volatility has been keeping you up at night, really weighing on you a good bit, have a little bit of extra cash. It'll certainly allow you to weather the volatility. Of course, most importantly, none of this says sell everything and go to cash. That is never a good idea. Getting all into cash is fine. The problem is getting back into the markets. If this thing does turn, it's going to be very hard to make that transition back into equity. So again, portfolio management long-term is about managing risk, trimming, working around the edges, trimming, pruning, just like a good gardener manages a garden. You've got to harvest your bounty when you have it, but you've also got to maintain your plants, and you can't go pick your tomatoes by ripping up the entire vine, right? So maintain some exposure to the markets. Understand that we are in still a bullish trend long-term in the markets. That has not changed, but we certainly want to be careful of what's actually here. Now, I've got some additional rules about long-term portfolio management. They're in the article on the website now. Technically speaking, will Santa visit Broad and Wall? That's on the website now at Real Investment Advice. I encourage you to read the whole thing, all the charts there, the explanations, but all the rules about managing the end of the year rally as well as managing your portfolio and what your expectations should be for your money are there in that article. I certainly encourage you to read it. And of course, make sure that you also join us later on today with our Lance Roberts Show podcast at our YouTube channel. Simply go to YouTube, subscribe to our Lance Roberts Show podcast. Of course, you can get all of our videos every day, our interviews, etc., on our website at realinvestmentadvice.com. Simply click the podcast tab. Thanks for watching. We'll see you next week for Technically Trading Tuesday again, right here, realinvestmentadvice.com. I'm your host, Lance Roberts.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.